Are you staring at a textbook trying to wrap your head around investment banking, M&A or IPOs, and feeling like you're lost in a sea of jargon? Maybe you're worried about those upcoming exams, or perhaps your dream of landing that high paying job in finance, but you're just not sure how to bridge the gap between theory and the real world application. Believe me, I've been exactly where you are. I remember the frustration of trying to connect the dots in complex financial concepts and courses. But here's the good news, it doesn't have to be that hard. I've spent years demystifying these topics, and I'm here to show you how to truly understand them, not just memorize definitions. My name is Max, and my journey started right where you are now. I studied finance myself, then pursued a master's degree in accounting and finance, all while working directly in the finance industry. I've seen these concepts applied in real time. This isn't just theory for me, it is what is lived and breathed in practice. Today, I'm giving you a foundational breakdown of core investment banking activities that will give you a serious edge on everybody else. What is investment banking? Let's dive into the fascinating world of investment banking, a field often shrouded in mystery, but one that's actually incredibly logical once you grasp its core components. While it might seem new with its modern reputation, the business of investment banking has existed for a long time. It was the separation from regular banking activities by the Glass-Steagall Act that truly forged the myth and growth of investment banks. At its heart, investment banking fundamentally deals with three key areas: corporate succession, acquisition financing, and initial public offerings. An investment bank primarily serves institutional clients. What truly defines investment banking is its intrinsic link to securities. Most deals in the sector are built around securities, whether that is for financing or for sales of said securities. Think of the investment bank as a crucial intermediary. On one side, you have capital takers like governments, financial companies, and non financial companies. On the other, you have capital providers, which include funds, insurance companies, foundations, and various financial and non financial companies. The bank stands in between, facilitating these vital connections. The fundamental value chain within investment banking is structured like this. First of all, the corporate finance unit acts as the primary relationship manager with clients. Behind them are product specialists who offer a core suite of services. These are mergers and acquisitions. Many companies even have their own internal M&A departments, like, for example, Siemens. ECM, which stands for Equity Capital Markets, and DCM, Debt Capital Markets. Here, CM stands for, well, capital markets. E is for equity and D is for debt. It's quite simple. This means ECM covers things like IPOs, while DCMs handle bond emissions. Both are primary market deals that need to be placed with investors who are the capital providers. Then we have structured finance. This involves financing large-scale projects like wind parks, bridges, or solar parks, with financing structured around future cash flows. Last but not least, there are derivatives, which we are going to talk about at a later point of time in a different video. Behind all of these specialists, there is the sales department, which is responsible for placing these primary market deals directly with clients, also called the capital providers. Beyond these, independent specialized departments include trading, which engages in proprietary trading for the bank's own account, and research. Research is crucial for valuations, especially for IPOs, as they bring together the price expectations of both capital providers and capital takers. They act as a vital link between sales and ECM or DCM, connecting with almost all departments. It is important to note that departments like sales are often separated, or, well, almost always separated from the core investment banking divisions by what is known as the Chinese wall. This separation is crucial to protect client information and shield the bank from legal issues. Fundamentally, investment banking can be seen as a systemized business unit, differentiated by its clients, business fields, and instruments. These elements combine to form unique scenarios and instruments. You'll also encounter different types of providers in the investment banking world, categorized by their product spectrum, geographic reach, overall size, reputation, and client focus, from bulge bracket firms like Goldman Sachs to specialized boutiques. Now, let's zoom in on mergers and acquisitions, or M&A. This field is gaining immense relevance, particularly in the context of corporate succession. While investment banks are heavily involved, many M&A transactions, especially smaller ones, are handled by tax advisors, auditors, and lawyers. The pricing in M&A generally depends on the transaction volume. Interestingly, there's a correlation between the stock price and M&A volume. When the economy is strong, more mergers occur as companies have more liquid capital, oftentimes through stock options or possibilities to use their stock as collateral for a deal. Additionally, nobody wants to sell at the market's low point, which is why IPOs and mergers often get postponed to a later point of time. M&A deals can take many forms. A merger typically involves the unification of two companies, often referred to as a fusion of equals. An acquisition, on the other hand, usually involves one party buying out another. This can be a friendly acquisition or a hostile takeover. However, you should note a hostile takeover especially requires a stock exchange listing, the presence of common shares, and a sufficient number of available shares. Joint ventures are also a part of M&A. Joint ventures are collaborations where two companies create a work together on a new shared entity. Then we have corporate successions, which are a very common type of M&A transaction, as they tend to come up with a business owner's life cycle of them simply exiting their company and, for example, selling to a competitor or an investor. Other important forms of deals include spin-offs, where specific self-contained business units are separated and often brought to the stock market, and carve-outs, which are similar but involve the separation of non-self-contained business units. You also have so-called management buyouts, or short MBOs, where the owner sells the company to its management, often requiring financial investors due to funding needs, and management buy-ins, also called MBIs, where a financial investor buys the company and installs a new management team. The motives behind M&A transactions are broadly categorized into strategic, financial, and other motives. The overarching goal, regardless of the type of deal or motive, is to increase the company's performance. However, it's a stark reality that half of all M&A deals do not result in performance gains for the buyer, often due to flawed management post-acquisition. However, you should note that usually strategic transactions are the ones that work out way better and also are a field where the buyer is often able or willing to pay a higher price or a higher premium for a company. Let's talk about the role of investment banks. Investment banks play a multifaceted role in M&A. Their tasks are varied but typically include project management, company valuation, conducting due diligence, structuring the deal, so whether to use cash or stock, negotiations, and communication of the deal. Crucially, an investment bank works for only one side of the transaction, striving to align its client's interests with those of the buyer or seller. Often, a significant portion of their compensation, sometimes as much as 80%, is tied directly to the transaction's success and price. The M&A process is meticulous. For sell-side mandate, which is generally the more attractive to investment banks due to a higher success probability, the process often starts with the companies inviting banks to a so-called beauty contest. This involves banks presenting their expertise, market assessment, company analysis, including a so-called equity story to make the company attractive to buyers, and a proposed process. Once a mandate is secured, the sales process typically unfolds in three phases. First of all, we have the preparation. This involves assembling the team, defining goals, conducting a vendor's due diligence, which is an in-depth company review by independent auditors paid by the seller, creating an information memorandum detailing a company's value proposition and financials, and selecting potential investors. For the second step, we have the execution. This phase begins with approaching potential investors, often using so-called teasers, short documents without the company's name to protect sensitive information. Interested parties then sign a non-disclosure agreement or NDA, followed by a letter of interest that includes an indication of valuation. This leads to management presentations and site visits by the possible new management. Last but not least, we have the completion. The final phase involves detailed negotiations, structuring the transaction financially, a final offer, the contract signing, and finally the closing of the deal, where the payment and share transfer occurs. When an investment bank is engaged in a buy-side mandate, they guide the buyer through a specific systematic acquisition journey. The process for the buyer typically involves several key phases. First of all, we have the kickoff of the acquisition strategy. This initial phase involves the buyer defining their transaction goals and framework conditions. It includes establishing a search grid for potential targets, analyzing the desired acquisition price range, and understanding their own core competencies. The buyer assesses current market valuations and prepares for initial discussion while maintaining confidentiality. Key motives for M&A on the buyer's side can be strategic, i.e., vertical, horizontal, or lateral growth, financial, which could be return expectations, asset diversification, or related to other factors like succession. The type of deal, such as a scale deal for expanding existing business, or a scoop deal for acquiring growth or specific capabilities, is also considered. Target identification and approach. A detailed analysis of the search grid is performed to identify potential targets. This involves creating a long list of all companies that could be considered for acquisition, which is then filtered and prioritized in a ranking system until a few promised targets remain. These targets are then approached often with anonymized preliminary checks and scouting, typically engaging with the target's top management. It's noted that the seller is usually in the driver's seat in an M&A process, so the buyer must adapt tactics and continuously analyze how to gain control of the process. For the next step, we have target valuation and fairness opinion. In this phase, the buyer conducts an in-depth analysis of the target's planning and annual financial statement. Workshops are held to identify and quantify potential synergies, as strategic buyers are often willing and able to pay more than financial investors due to these synergy factors. A business model analysis is developed and critical success factors and pitfalls are identified. The efficient use of financial auditors and tax consultants is crucial. For company valuations, methods like discounted cash flow, DCF models are almost always used. However, there are also different ways to value a company, obviously, like doing certain multiples of, for example, the EBITDA. Often, also in general, multiple models are applied to form an average value, which is then, in essence, going to form the purchase price. Then comes preparation due diligence. Prior to the comprehensive due diligence, a transaction planning workshop is conducted and transaction-specific due diligence checklists are created. After this, the execution due diligence follows. This is a critical stage where the buyer performs a thorough check of all factors related to the target company, including legal, financial, tax, environmental, market, and strategic aspects. The buyer visits the data room, which can be thought of as the room where every paper regarding a company, like the financial reports of the past and so on, are stored. They here review audit reports and strategic documents and work on developing optimal contract structures. While a vendor's due diligence may be conducted by the seller, the buyer's own due diligence is crucial for determining the purchase price. A due diligence report is then prepared. Following this, we have the signing and closing. During this phase, the investment bank provides support for contract negotiations and assists with transaction-specific public relations and investor relations. Coordinating of subsequent topics, such as potential purchase price adjustments, is also handled. The structuring of the deal is key. Determining how the purchase can be financially implemented, so through cash or shares, is also a key role. Acquisition financing typically involves a combination of internal financing, capital market financing, so for example, bonds, capital increases, syndicated loans, or something like bridge loans, as few companies have enough cash readily available for direct purchase, especially if you're moving to the higher segment of bigger companies. After a deal is closed, we have the post-deal. This final phase marks the beginning of the actual integration of the acquired company into the buyer's organization. This is where the real work for the buyer starts. The success of M&A transactions is often dependent on factors like a clear strategy and a robust integration process post-acquisition. A critical component throughout these processes is due diligence, which involves examining all factors: legal, finance, tax, and so on. For financing acquisitions, a combination of methods is usually preferred, with internal financing and capital market financing being popular. However, it should be noted, most M&A failures occur during the integration phase post-deal, highlighting the importance of a clear strategy and a sensible business model for after the transaction. Let's now turn our attention to initial public offerings, or short IPOs, often called a company's stock market debut or going public. This is when a company first offers its shares to the public. The decision to go public is always made by the owners, known as the existing shareholders. For an IPO, a company must have an exchange-listed legal form, such as Société Européenne or the German AG, and obtain admission to stock exchange trading. Shares for an IPO can come from two sources, either from the existing shareholders, with proceeds going to the shareholders, or from a capital increase with proceeds going to the company itself. There are compelling reasons for a company to go public. First of all, it simplifies succession planning for existing owners. It strengthens the company's equity, it helps ensure the company's continued existence, it provides an easier path to financing future acquisitions, and it simplifies the process of employee participation. The IPO process itself is a multi-phase endeavor, typically involving several banks and consortium led by a lead manager who coordinates the entire process. You can visualize this process as follows. First of all, we have the planning and preparation. This involves initial discussions with the stock exchange, forming an internal IPO team, selecting advisors and a consortium of banks, and establishing legal prerequisites. Second of all, we have the structuring. Here, the equity story, the compelling narrative for why investors should buy the shares, is developed. A detailed timeline and business plan are created, and a due diligence is conducted. Third of all, realization and marketing. This phase includes investor relations activities, publishing the prospects, conducting market research, applying for securities admission, and a crucial pre-marketing and roadshow. During roadshows, the company's management presents to potential investors to generate interest. These, for example, are usually insurances or huge funds. The fourth step is the pricing and secondary market. This final phase involves the actual price determination and the allocation procedure for the shares, followed by the commencement of continuous trading on the exchange. The IPO price is determined collaboratively by all participating banks and their research departments, leading to a consensus price expectation. During pre-marketing, large investors are consulted to gauge their willingness to pay, which helps establish a price range for the shares. The actual subscription period then begins, and the book building process manages the order book and allocates shares to which investor should get them. The lead manager also often undertakes price stabilization efforts for a short period of time after the IPO to absorb any excess selling volume on the secondary market of, for example, pre-existing investors. If this video helped you untangle some of the complexities of investment banking and sparked your interest in diving deeper, then I've done my job. For more in-depth insights, practical guides, and resources designed to boost your finance knowledge and career prospects, make sure to click the link in the description below. There you'll find everything you need to take your understanding to the next level. Don't forget to like this video, subscribe for more content, and let me know in the comments what other finance topics you'd like me to cover. Thanks for watching, and I'll see you in the next one.